Here we have a study of selling zones on the ES S&P Mini using a daily time frame. Now, behind us we may have distribution, and now we're in the phase of markdown. So what I mean is we have accumulation, and now we're just in markdown. And all the best selling zones that I have traded and encountered are in active downtrends. And of course, this is time frame dependent. However, we don't need distribution to have selling zones. This here is merely a mild cause being built for the effect for us to come down, which is the same as accumulation. We don't need to come from accumulation to have buying zones. The point being, when we're in a downtrend and we do have distribution behind us, I mean, this could be, we're in an active downtrend. When we do have selling zones, they yield more, as in potential profits, as in we get larger moves from selling zones in a downtrend, which makes sense. So if we're in an uptrend and we spot a selling zone, we might come down to here, natural place, or to here, a natural place, and then resume on our trend. However, if we come from a downtrend and we encounter a selling zone, the odds favour that we have more continuation to the downside. Ergo, it's wise to hold our trades for longer if we can. The odds of selling zones producing bigger moves in the overall context of a trend, as in a downtrend, yields better price movement, as opposed to being in an uptrend. Again, we can use selling zones here as single entities. We don't need to come from distribution. We are in an uptrend here, clearly. All we need to do is to be able to recognize the behavior, the price action. So we're in an uptrend with evidence of good buying. We can clearly see this. Nothing too wacky, sustained volume, buying of good quality. If anything, we're rising a little fast, too fast too soon, maybe a slightly parabolic. Anyhow, we encounter this bar here. Similar volume, spread has narrowed, close off the highs, closes cluster. So therefore we know selling is in this bar. Okay, but at this point I wouldn't be thinking this is weakness. I'd note there is selling, we're in an uptrend and we're not reacting down. So I'm thinking we're holding gains. From here, we kind of drift down in the closes. And I would note there is perhaps a little bit of selling here as the closes do cluster, but we're not reacting. That's what's important. We're still holding here. Okay, we're still in an uptrend and supply hasn't proved itself. And then we push up again, and what happens? Here, here, and here. Selling off the highs. Selling off the highs. Selling off the highs. Here and here. So now, 5 out of 6 days, we can clearly see that sellers are capping upside progress. And the closes are drifting down once again. And this widespread bar, with this pop in volume, there is supply. Although it does close fairly firm, sellers were able to drive it down in the first place. We don't get this kind of retracement into any bar within this uptrend. This tells us that supply is in the market. Buyers did manage to close the bar fairly firm. We have to note that. And also, technically, it is a down bar. Okay? So what we take away from this is that sellers had enough force to drive it down. We can clearly see sellers capping progress here for whatever reason. Closes are drifting down. So now price is unable to rally in an uptrend and supply is making itself evident. So we'd note this. This is interesting behaviour. Then a few more days pass. What do we notice? We push up, close weak, push up, close weak. Now this area here we have to draw. And this would be our selling zone. Don't forget this is a daily time frame, and sometimes a line, although this works, we can see that it is an area where the professionals are selling. They work in areas, and this appears to be a 5-point, 4-point area. But we want to be aware of an area and not just a line. Okay, although the line works, when it comes to daily time frames, I do like to work in areas, especially when it's as evident as this. So yes, push up, more selling, push in there, sell off, close, pop ahead, here, pop, close, pop. Every time we dip into this area, it results in sellers capping upside progress all along here. So that's for 1, 2, 3, 4, 5, 6, 7, 8. So 15, 16 days. For all this time, 3, 4 weeks, we're banging our head, unable to make upside progress in an uptrend where sellers are capping the market with evidence of supply. This is the S&P, the most liquid contract in the world, for 3 weeks making no upside progress. We have to pay attention. Bar A, this is where it gets interesting. We have the narrowest bar close in our selling area with no volume. It's the lowest volume on the chart. So this is clear, no demand, as in there's no buying force to the upside. That has closed in our selling zone. Okay. And then bar B, drive into new highs, reverse to close weak, back under the selling zone with a surge in volume. So this bar stop hunts, and look how much tau we have to work with. As it breaks these highs or these highs or these highs, this will induce breakout traders and bulls to buy. Don't forget, at some point it would be here or here, and this would be a strong, good, decisive breakout to some traders, and they'll be buying. Yet sellers come in force to slam it back down on its lows under the selling zone, catching all these traders off guard. 10 points in the S&Ps, that is tens of thousands of contracts. So we can sell bar A, and if we put our stop here, we get stopped out. That's okay, that's part of the game. That is a valid trade. I would take this trade 100 times out of 100. Yet, as we reverse and close back under, I'd also take bar B. This is a good reversal. Hidden upthrust, an upthrust. Label it as you will. But this is evident weakness after no demand. So this is a superb setup. So from A, we slam down with a good move. This is selling of good quality with volume increasing. And then we rally back up to this area. What do we notice? Well, first of all, volume declines on the rally. And then look, capping, we cluster. We touch here. Again, we close off the highs. And if you're using multiple time frames, you can get in here for a clean entry. Again, we slam down. So this market, for whatever reason, is weak and deems this area of value. This action all originated from the selling zone. The market is kind and provides a clean entry. However, it does take time. Don't forget, this is a daily time frame, and for over 3 weeks, we're sitting on our hands. This is why we need to be watching other markets if you're trading on higher time frames. And taking the entry on B, we can use multiple time frames. We don't have to wait for it to close. If we can see it rally and we note that demand decreases at the highs, then as we reverse and fall back down and we see volume increasing, so we have buying of poor quality at the highs and then selling of good quality as it drives back down, as we break this close, we can let the market pull us in. We don't have to wait for the close. Here we'd save 5, 6, 7 points. That's 35 ticks. That makes our stop more comfortable because our stop would have to be above this high. Let's just take a step back and look at A. The only close we get in our selling zone has the lowest volume and the narrowest bar. It generally is fascinating. Now you are beginning to understand these principles and can see the lack of selling force. It becomes quite clear. We have been in this area for 3 weeks, capping time and time and time and time and time and time again. Then all of a sudden, this little bar with the narrowest band and low volume closes in there, alarm bells must ring. There must be a sudden little alarm, ding, 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 ding. And, our spider sense must go up. Something is incorrect. Something is off. Okay, and this would go on our watch list. Good. Are there any questions for this chart?